We have our good friend Larry Swedroe on the line, and he's going to help us out, Al, with this decisions that people got to make. Larry, we were talking earlier about all the money sitting in IRAs and 401k plans. And now the SEC is kind of taking a look at these rollover rules. And then there's some unscrupulous sales practices when it comes to selling them variable annuities or maybe non-traded REITs.
Really? People exploit the lack of knowledge of investors by doing such things?
Isn't that crazy? And so what we're trying to do today is to educate our listeners to say, all right, well, here, maybe you don't go down that road with an advisor. And if you can do it yourself, you're going to save some money in cost and fees. But there's pros and cons to that. Or you might want to hire a fiduciary advisor. There's pros and cons to that. So let's bring in one of the smartest minds in finance to kind of help us make or have our listeners come up with that decision. So what do you think, Larry, with all of this? Should people invest their money on their own, or should they hire an advisor?
Well, I think there's a lot of sides to the question, but I would start off by pointing this out. In any area, the question is should you do it yourself when you save the money and the time, or hire a professional? With most of us, we have a minor medical issue. We might even treat it ourselves. You got a headache or a cold, but if need brain surgery, you certainly wouldn't practice on yourself or your wife. So the more important the issue, the more a mistake can be costly, the more you should be willing to hire the professional, because sometimes you'll make mistakes that you just simply can't recover from. In my case, I hire anybody to do almost any work around the house, because I know if I try to do it, I'll screw it up so badly it'll cost me much more to pay somebody to undo my errors than if I would have hired them, the professional, in the first place. So, that's the way I start off by thinking about it. What's the cost of making mistakes if I do that? If it's easily recoverable from, you might try and do it yourself, but if it's a big mistake, and in the world of investing, you can make mistakes you cannot recover from, then I think you want to be much more careful in making that decision. So that would be my starting point.
Yeah, great point. So if it's a big loss, maybe I want to push that off to someone that has a little bit more experience versus, well, if I lose a couple of bucks, well, that's all right. I can probably recover from that.
Yeah, I think that's exactly the kind of thinking I would apply. So obviously there are people who believe that they could do it themselves. I think one of the problems, though, is that there's an all too common human problem that we tend to be overconfident in our skills. It doesn't matter whether you ask people if they're a better than average driver or a better than average lover. 90% of the people will say they're better than average, which by definition can't be true. So one of the problems people have is they're really not honest with themselves, or they're not capable of making the judgment, but so they tend to think they have the skill sets necessary. So I came up with 5 questions I think are important for people to ask themselves to see if they could at least consider doing it on their own. And, of course, it's only helpful if you're honest in answering them. So the 5 questions are in this order. Number 1 is, do I have the knowledge needed to develop an investment plan and then integrate that into an overall estate tax and risk management plan, and then provide all the ongoing care and maintenance that is required? In other words, having an investment plan is only a necessary condition for success, because investment plans can blow up for reasons that have nothing to do with investing. It might be that you didn't have enough life insurance, or you didn't have an umbrella policy, or you set up trusts but you didn't fund them properly, or it might be that you didn't rebalance the portfolio or take advantage of opportunities to tax loss harvest. So if you don't have the knowledge to do all those things, you've already failed the test. No need to answer the rest of the questions. But if you do, the second question would be, do I have the mathematical skills that are needed? I believe that investing does require knowledge that goes well beyond even simple arithmetic. You need advanced knowledge of probability theory and statistics, such things as correlations and what are called the various moments of distributions, terms beyond standard deviation to to include skewness and kurtosis. Those are fancy words that mean you have non-normal distributions, like a lottery ticket. Most of the outcomes, are basically you get $0 back, but a few of the outcomes are spectacular. So that doesn't look anything like a normal distribution. That would be what would be called a right-tailed with positive skewness, a very big right tail where you could earn $1 million or $10 million or whatever, but most of the outcomes are minus 100%. Well, investing is much closer to that in many cases than normal distribution, so you need to have that knowledge. The third question is, do I have the ability to determine the appropriate asset allocation, one that provides the greatest odds of achieving my financial goals while not taking any more risk than I have the ability, willingness, and need to take. Now, I've written books, including The Only Guide You'll Ever Need to the Right Financial Plan, that can help people identify that. But you still, even if you're able to do that, you then need to be able to run what is called a Monte Carlo simulation, so you can determine what the odds of success are appropriately. And you need to know all of the inputs and how to run the program. So you need to know what the assumptions are for rates of return. So can you estimate future returns for every asset class, including putting in the right standard deviations, what the correlations are? And unfortunately, many of these programs are difficult to use. Some even have flaws that aren't easy to spot. So because of that complexity, it's very easy for novices to make serious mistakes, and that could lead to very bad decisions, which can sometimes have consequences which you can't recover from. The fourth question is, do I have a strong knowledge of financial history? By that I mean you need to be aware of how often stocks have provided negative returns, how long bear markets have lasted, how deep they have been, because those who don't know their history are very likely to repeat past mistakes. A good advisor will know their history and help you avoid that mistake. And the last question is, even if you have all that knowledge, is this: do I have the temperament and emotional discipline needed to adhere to a plan in the face of the many crises you're almost certainly likely to face? In the last 40 years, I've looked back, and we've faced about almost approaching 20 serious financial crises of one type or another. 3 of them resulted in drops in the market of 50% or so. So if you've got another 40 years ahead of you, you're probably going to experience a big crisis every year or two. And the question is really, are you confident that you really will have the fortitude to withstand a severe drop in the value of your portfolio without panicking? Will you be able to rebalance, which means you've got to buy more equities just when it looks darkest and all your friends are losing their heads and you've got to try to keep yours? Very few people, I think, can do that. And lastly, I'd ask yourself, have I always done the right things, and have my returns really matched the returns of my investments because I did stay disciplined, or is the evidence from my own past contrary to that?
Larry, I couldn't said it better myself.
That was wonderful.
No, but here's the point, is that when you look, you got some individuals say, all right, well, here, I'm going to pick a couple of different mutual funds, and then, hey, I think I have some core funds that I'm just going to let it go, not deal with it. But that's just one side of things. There's so many other issues when it comes to having an overall effective investment strategy. Are you going to stay disciplined when markets go bad? Are you not going to get greedy when markets are continuing to go up? Do you have any knowledge when it comes to taxes and how to take distributions, tax loss harvesting, or if I blow up my IRA and all the money comes out taxable, do I have a disciplined plan to make sure that I'm investing my assets towards the specific goals? Those are so key components of an overall effective and efficient investment strategy that I really don't think most people thought of.
And I really like what Larry said about that you really should look at how you've done in the past. And if you've done a great job in the past, maybe you should continue. But if you've had some problems with investing, and most of us have, maybe you want to get some help, especially when you're talking about your retirement nest egg, and you do not want to make mistakes there.
So here's what we've talked about today, just to kind of wrap everything up in a big bow, is that, all right, you have an opportunity to roll your 401k into an IRA. Should you or shouldn't you? We looked at fees and costs inside the overall plan. If you keep it in the plan, is it higher or lower? Then you want to take a look at the distributions. If I'm 55, I don't want to take it out because there's no 10% penalty. If I'm in my 70s and I'm still working, I don't want to roll that money out because then I don't have to take a required distribution. Then we looked at, all right, well, what are the tax consequences? If I die, what is can I stretch it? Can I do a Roth conversion? There was a lot of different avenues that we kind of dived into to make sure, are you doing the appropriate things with that 401k dollars? And then finally, of course, is the investments. Are you disciplined? Do you have knowledge of markets? And Larry, thank you very much for joining us today to kind of end the show, to wrap things up, and to give your perspective. Someone that's been in this business for 20 some odd years. The firm manages billions and billions of dollars, one of the brightest minds in finance. And it's not necessarily, okay, well, you have the cookie cutter asset allocation. That's great. But there's so many other components. So if you want to come in to our office for a free assessment, sit down with Big Al, myself, or any other advisor to take a look at all of these different factors to make sure that you're doing everything appropriately with the 401k dollars, your IRA dollars, whatever retirement plans that you have, or any assets outside of it. You want to have a straight strategy to make sure that you're doing everything appropriately. Here's the number one last time. Now, next 10 minutes, then we're shutting the phones down. Everyone calling the next 10 minutes will get in for free. 888-994-6257. 888-994-6257. That's 888-994-6257 or 888-99-GOALS. That's 888-994-6257. Thanks so much for joining us, Larry Swedroe. It's always a pleasure to have him. For Big Al Clopine, I'm Joe Anderson. Have a great weekend, everyone. The show's called Your Money, Your Wealth, right here on AM 760 KFMB. We'll see you next week.